IAS 32 is about financial instruments. So what is financial instruments? It is any contract that gives rise to both a financial asset of one entity and a financial liability or equity instrument of another entity. Its main objective is to establish principles for presenting financial instruments as liabilities or equity and for offsetting financial assets and liability. So basically, it provides definitions of financial instruments, prescribes the rules for classification of equity versus financial liability, and also describes compound financial instruments. It also provides the rules for accounting for treasury shares and offsetting. The scope of this standard applies in presenting and disclosing information about all types of financial instruments, applies to those contracts to buy or sell a non-financial item that can be settled in cash or another financial instrument. It applies to all derivatives and interests in subsidiaries, associates, or joint ventures. The exceptions are interest in subsidiaries, associates, and joint ventures accounted for under PAS 27, 28, 31, and IFRS 10. Employers' rights and obligations under employee benefit plans. Next is insurance contracts, contracts and obligations under share-based payment transactions. So let's proceed to the second slide. We're not gonna look at recognition, how we measure them, and how to disclose them. But are we gonna do that? Obviously yes, but in a separate recording and in a separate IFRS. We'll only have to learn what are financial assets, financial liability, or equity instrument. A financial asset is defined as any asset that is a cash. Cash is a financial asset. It is also an equity instrument of another entity, which is basically a stock or an investment of another entity. Basically, you bought a stock from another entity. It could be a contractual right to receive cash or another financial asset from another entity. When do you have the right to receive a financial asset? If you buy a debt instrument, when you buy a bond, you debit that investment and credit cash. What happened is, you bought a bond, and by buying a bond, that's gonna give you the right to receive cash. It could be a contractual right to exchange financial assets or financial liabilities with another entity under conditions that are potentially favorable to the entity. Here we are talking about call options and put options. What are these? Call options gives you the right to buy an asset, to buy a stock in equity at a certain price, while put option gives you the right to sell. It is a contract that will or may be settled in the entity's own equity instruments. So it is not your equity instruments. It could be non-derivative for which the entity is or may be obliged to receive a variable number of entity's own equity instruments. It could be a derivative that will or may be settled other than by the exchange of a fixed amount of cash or another financial assets for a fixed number of the entity's own equity instruments. Putable instruments classified as equity or certain liabilities arising on liquidation classified by IAS 32 as equity instruments. We have financial instrument. It is a contract between two parties, and this agreement has some clear economic consequences, and also the parties to it cannot avoid the contract. Let's talk about financial liability. It is a contractual obligation to deliver cash or another financial asset to another entity. When you sell a bond or when you raise money using bonds, you're gonna have to pay interest. You're gonna have to transfer or deliver cash to another party. For example, the financial asset holder is a financial asset holder that would receive the cash. You would have financial liability. Why? Because now you need to pay the cash. So note this, financial liability is gonna ask you to deliver cash or another financial asset. If you look at financial asset, it has a right to receive cash from another entity. Notice, one company could have a financial liability. The other side will be the financial asset. It could be a contractual obligation to exchange financial assets or financial liabilities with another entity under conditions that are potentially unfavorable to the entity. Again, here we're talking about call or put options, but you might retain those calls and options. Also, a contract that will or may be settled in the entity's own equity instruments. Sometimes you have to pay off your liability using your own equity instruments. You have a bond. What's going to happen if you're going to pay off that bond? Maybe issuing some equity instruments. Your own equity instruments, it means your own company stock. So you would exchange your bonds with stocks. It could be a non-derivative for which the entity is obliged to deliver a variable number of the entity's own equity instruments. A derivative that will or may be settled other than by the exchange of a fixed amount of cash or another financial asset for a fixed number of the entity's own equity instruments. So examples of financial liabilities includes payables, loans from other entities, issue bonds, other debt instruments, and obligations to deliver the entity's own shares for a fixed amount of cash, and written put options. Then we have equity instrument. It is any contract that evidences a residual interest in the assets of an entity after deducting all of its liabilities. The important thing here is the residual interest. So if we take assets of some company and deduct all of its liabilities, the result is equity, which is sometimes called net assets.
Fair value is the amount for which an asset could be exchanged or a liability settled between knowledgeable willing parties in an arm's length transaction. Putable instrument, a financial instrument that gives the holder the right to put the instrument back to the issuer for cash or another financial asset, or is automatically put back to the issuer on occurrence of an uncertain future event or the death or retirement of the instrument holder. In other words, an entity may issue putable shares and the holder may return the shares at any given time back to the entity for cash or any other asset. Moving forward, so the fundamental principle of PAS 32 is that a financial instrument should be classified as either a financial liability or an equity instrument according to the substance of the contract, not its legal form and the definitions of financial liability and equity instrument. Given here are some illustrations: the preference shares and the issuance of fixed monetary amount of equity instrument. For preference shares, if an entity issues preference shares that pay a fixed rate of dividend and have a mandatory redemption feature at a future date, the substance is that they are a contractual obligation to deliver cash and therefore it should be recognized as a liability. In contrast, preference shares that do not have a fixed maturity and where the issuer does not have a contractual obligation to make any payment are equity. For the issuance of fixed monetary amount of equity instrument, a contractual right or obligation to receive or to deliver a number of its own shares or other equity instruments that varies so that the fair value of the entity's own equity instruments to be received or delivered equals the fixed monetary amount of the contractual right or obligation is a financial liability. For contingent settlement provision, the issuer does not have an unconditional right to avoid settlement by delivery of cash or other financial instrument. The instrument is a financial liability of the issuer unless the contingent settlement provision is not genuine and the issuer can only be required to settle the obligation in the event of the issuer's liquidation. The instrument has all the features and meets the condition of PAS 32, 16A, and 16B for putable instruments. This last slide contains different discussions related to PAS 32 financial statement presentation. First, we have the putable instruments and obligations arising on liquidation. As a result of the amendments by the International Accounting Standards Board with regards to PAS 32 and PAS 1 presentation of financial statements, with respect to the balance sheet classification of putable financial instrument and obligation arising only on liquidation, some financial instruments that currently meet the definition of a financial liability will be classified as equity because they represent the residual interest in the net assets of the entity. Next, for the classification of rights issues, The International Accounting Standards Board issued an amendment to PAS 32 on the classification of rights issues. For rights issues offered for a fixed amount of foreign currency, current practice appears to require such issues to be accounted for as derivative liabilities. The amendment states that if such rights are issued pro rata to an entity's all existing shareholders in the same class for a fixed amount of currency, they should be classified as equity regardless of the currency in which the exercise price is denominated. For compound financial statements, some financial instruments, sometimes called compound instruments, have both a liability and an equity component from the issuer's perspective. In this case, this standard requires that the component parts be accounted for and presented separately according to their substance, based on the definitions of liability and equity. The split is made at issuance and not revised for subsequent changes in market interest rates, share prices, or other event that changes the likelihood that the conversion option will be exercised. To illustrate, a convertible bond contains two components. One is a financial liability, namely the issuer's contractual obligation to pay cash, and the other is an equity instrument, namely the holder's option to convert into common shares. So another example is debt issued with detachable share purchase warrants. For treasury shares, the cost of an entity's own equity instrument that it has reacquired is deducted from equity. Gain or loss is not recognized on the purchase, sale, issue, or cancellation of treasury shares. Treasury shares may be acquired and held by the entity or by other members of the consolidated group. Consideration paid or received is recognized directly in equity. Explain the offsetting of a financial asset and a financial liability. Generally, a financial asset and a financial liability shall not be offset. However, the standard provides that an offsetting is allowed when two conditions are met. First, the entity has a legally enforceable right to set off the amounts, and the entity intends either to settle on a net basis or to realize the asset and settle the liability simultaneously. For the cost of issuing or reacquiring equity instruments, these are accounted for as a deduction from equity, net of any related income tax benefit. Lastly, disclosures for financial instruments are in PFRS 7 Financial Instruments Disclosure and no longer in PAS 32. The disclosures relating to treasury shares are in PAS 1 Presentation of Financial Statements and PAS 24 Related Parties for share repurchases from related parties. So that's all for PAS 32 Financial Instrument Presentation. Thank you.